Welcome to the Lane Gorman Trubid COVID-19 Financial Webinar Series. In this series, our accountants and advisors will provide you with the information to make sure your business has the tools it needs to survive the lockdown. This webinar is about how dealerships can take advantage of SBA loans to help keep their businesses afloat. It was recorded live as a Zoom webinar on April 2nd, 2020, and all information was accurate and up to date at that time. There is a Q&A at the end, but if you have any questions, please feel free to email us at askus@lgt-cpa.com, and we will get back to you as soon as we can. I hope you enjoy the webinar.
We'll go ahead and mention a couple of things. We'll have, and I'll mention this again once we are ready to get started, but we'll have more open Q&A towards the end if we have time. If you're new to Zoom, on the bottom part of your screen, you have several different options. One of them is Q&A, and in that Q&A, if you click on it, it should pop up a screen, and you'll be able to start typing up any specific questions that you have. Now, we'll review all those questions when we get to that point and start identifying ones that we've already addressed or those that are very, very specific, and we'll try to get back with you on those specific ones, maybe not bring it up with the group. And then any other questions we'll try to get handled within this group. So I think we're ready to get started. I'm seeing a few hands raising. I'm not exactly sure what that means, but I think we're going to all learn. All right, I see raising hands. I think you're probably raising hands to ask questions already. So tell you what, let's work on how we're going to handle the questions that come up. So as I mentioned, let's just go ahead and populate your questions that you have in the question and answer module. That will be able to allow for us to be able to orderly answer your questions. So let's go ahead and get started. I'd like to thank everybody for joining our webinar. I know this is a little last minute, but we're trying to be as quick as we can at getting information out to you. We're focusing today on the SBA loans. And so that's going to be our specific topic. We're going to focus more on dealerships, but the majority of what we're talking about today is applicable to all businesses. So while there'll be some nuances, this should apply to any and all businesses that are eligible for the various programs. I'd like to start by introducing the presenters. First, I'd like to give a big thank you to Katie Lyles and Josh Woods, who helped put this together and make this happen for us. And of course, make the content work out well for you guys. Our panelists today, I'm Colin Kinelakis. I'm a partner in the dealership services group for Lane Gorman Trubid. We're a CPA firm, full service CPA firm based in Dallas, service dealerships all over Texas and the Southwest in different parts of the country. I'm joined by Patrick Riley. He's another partner within our dealer services group. He handles mainly assurance and consulting for our dealership clients. I handle assurance, consulting, and tax with our dealership clients. Ryan Cole is joining us. He is one of our tax partners. He's on here to help with a lot of technical matters because there's so many technical matters that come up in this presentation, and he'll be a great addition to this group. And many of you know Denver Todd. He's senior manager in our tax department, and he specializes in dealerships. PowerPoint presentation, you can thank him for it. And we'd love to be resources to you all as you work through your questions and working through your applications and in all these nuances. But we're hoping that the Q&A format here, we're going to basically go through and identify the most common questions that we've been asked in working with our clients and the answers and guidance that go along with it. You're going to find some of these questions don't have definitive answers, but we're not afraid to ask those questions and tell you. We're expecting more guidance to come out, specifically on the reimbursement piece, but there's quite a bit of time between now and when that reimbursement's going to happen. So hopefully we'll get more answers then. So one other thing I wanted to mention, we as a firm, we have controllers roundtables for our dealer services. We're hoping to have one in June. Not quite sure if that'll happen, but we'll see. We'll have one in October, and that will be in San Antonio. So reach out to us if you don't know about our meetings. We'd love to have you join us. So we're going to go over the basics of the two SBA plans, the PPP and the EIDL plans. The PPP plan is the Payroll Protection Plan. The EIDL loan is the Economic Injury Disaster Loan Plan. As I mentioned, we'll work through Q&A. I can see many of you have started putting some questions out there. That's great. We appreciate that. We'll get to your questions towards the end, and hopefully many of those questions have already been answered. If they have, we will not ask the group. If we find good commonality in the questions that have been asked, then we'll go ahead and get that to the group and get those answers out. I'm going to hand it over to Denver. He's going to give a kind of a high-level view of these two different plans so you can have a good base understanding of them. We're expecting that you all at least have some baseline familiarity, so this won't be a true 101. It'll probably be more of a 201. I'll turn it over to Denver.
Thank you, Colin. I've already noticed a lot of questions already coming through. So as you guys probably know, let me make sure. There are some SBA loans that are out there that you probably have heard about, and the Paycheck Protection Program loan, or PPP, and the Economic Injury Disaster Loan, which is the EIDL loan. Here's a comparison of these loans and the other traditional SBA loan that you can apply for. Before I get started talking about the differences between these two loans, I do want to mention, as I go through this PowerPoint, I will be skipping some slides and we'll come back to them later during the Q&A section. We just have received a lot of questions about certain areas, and we feel like it'll be better to highlight them in that section. And we feel like this will give everyone a better understanding of how this all works. Okay, so the Paycheck Protection Program loan, or the PPP loan, this came into effect when Donald Trump signed the bill, the CARES Act, on last Friday. The Economic Injury Disaster Loan, or the EIDL loan, and the traditional SBA loan have been around for a while. And just to go over some of the main differences between the PPP loan and the EIDL loan. The PPP loan, you're going to have to apply through a lender that is approved by the SBA, whereas the EIDL loan, you just go directly through the SBA's website and apply online. There's a difference in the maximum loan size for the PPP loan. There's a payroll component, and we'll get into that in a few minutes. There's no guarantee, no collateral needed for the PPP loan, and the duration, it was supposed to be up to 10 years, but the Treasury has come out and clarified that it looks like it's only going to be a 2-year loan, and the interest rate was supposed to be up to 4%, but it looks like it's going to be a 0.5% based on the guidance that's out. And the main thing that a lot of people are interested about this PPP loan is that there's forgiveness available, assuming that you use the loan proceeds for qualifying expenses at the end of the loan, this 8-week period. You can possibly have a portion of the loan forgiven, and we'll get into that. One of the main questions that we have received is, can you apply for both loans? Yes, you can, but you can't use the loan proceeds for the same type of expenses. And I'm not sure how many of you have looked at the PPP loan application, but on the application, you actually have to check what expenses you will be using the loan for. And we will get into those in a second. Okay, so we're briefly going to cover, sorry guys, 1 second. I need to turn on the video apparently. I don't have it on. All right, there we go. Okay, so I'm going to cover the a little bit about the application, the eligibility, the key terms, how much can I borrow, what can the funds be used for, and how much the loan will be forgiven. Okay, so for the PPP loan, there's been $349 billion allocated to this program, and it's on a first come, first served basis. Businesses will, start being able to apply with their lenders starting tomorrow. So it really is first come, first serve. So you want to get your application in as soon as possible. One of the main questions is on the filling out the application. There's one application per business tax identification number. So if you have separate legal entities, you're going to apply for a loan for each legal entity. And that link at the bottom of the slide, you will be able to find the application form. Okay, so who is eligible? You would have had to been in business on February 15th of 2020. You paid salaries or employer taxes for employees. And one of the big question items, and we'll come back to it towards the end, you have to have 5 or fewer employees. And there's some affiliation rules where when you're counting employees, you have to count employees of affiliates. So we will come back to that because I know there are some groups that have multiple dealerships or multiple entities, and we'll discuss that more towards the end. Okay, so the key terms of this loan, as I mentioned earlier, it's a 0.5%. It's a 2-year loan for the balance that's not forgiven, because remember, you're going to get a loan amount and it's not guaranteed that you're going to get the full amount forgiven depending on what expenses you spend within the testing period. So the portion that's not forgiven is going to be a 2-year term, no collateral, personal guarantees, or prepayment penalties. And a question that's come up a lot is do you have to seek credit elsewhere to show that you can't find a loan somewhere else? Or do you have to have credit worthiness? Are they going to, is the lender going to ask for your tax returns and a bunch of other things? No, they're not. They're basically trying to get money into the hands of businesses as soon as possible. And it's on the back end when you're requesting forgiveness that it's going to be stricter on what type of expenses will qualify to be able to receive forgiveness. Okay, so the maximum loan amount, in general, it's going to be 2.5 times the borrower's average monthly payroll costs, or 10 million. And right there, you'll see the time period for average monthly payroll costs. The statute actually says the 12 months prior to the date of when the loan's made. So if you, I know this isn't possible, but if you got the loan funded on April 1st, the period that you would, per the statute, is you would go from April 1st, 2019 to March 31st of 2020. But when the application came out, it's stating that you can use 2019 payroll. So this is going to be something that you're going to have to work out with your lender when you are going through the application process. I think using the 2019 numbers will be better because your payroll is going to be higher at that point, because in 2020 you probably had a slowdown in the sale of cars and your compensation's gone down. And then at the bottom, if you weren't in business in 2019, there's that's how you would calculate your average payroll costs. Okay, so what are the amounts that go into payroll costs? You have your wages, compensation, salary, and it's only on the first 100,000. Cash or tip equivalents, paid leave, separation or dismissal allowances, which would be severance pay. You have group health benefits and insurance premiums, retirement benefits, state or local employment taxes, what you'd pay the Texas Workforce Commission. And then we'll come back to this one at the end. There's some confusion over if you can include payments made to independent contractors that you've issued 1099s for, and we'll get back to that in the Q&A section. And then what's not counted, any compensation over 100,000, payroll taxes, and then qualified sick and family emergency leave. With the COVID-19, the second phase, there were some payroll tax credits that came out, and any wages that qualify for those credits will not be counted as payroll costs for if you're applying for this loan. Then when you're calculating, well, let me step back. The payroll cost definition is used for the payroll cost that you calculate the original loan amount, and that's also used as when you're defining what costs qualify for forgiveness at the back end when you're trying to get the loan forgiven. So you wouldn't actually have the qualified sick or family emergency leave when you're doing the prior 12-month period testing. Okay, and then we'll come back to the examples towards the end. What can the funds be used for? This is actually more liberal than when you're applying for forgiveness. The funds or the expenses that you pay within the 8-week period are more strict than what's provided here. So the acceptable use of funds: payroll costs, interest, rent, utilities, and interest on any other debt obligations that were incurred before February 15th. It's believed that if you had that floor plan interest expense might be deductible on vehicles that were acquired before February 15th, but we will have to get more guidance, and we'll discuss that more in a few minutes. Okay, so now we're going to talk about how much of the loan will be forgiven. So when you get the loan, there's going to be an 8-week period that you're going to test, and any of these expenses that are listed below will count towards your tentative loan forgiveness amount. So what payments are covered under the 8-week period? So it's going to be payroll costs, what we've defined earlier. It's going to be interest on mortgage incurred before February 15th. We'll get back to whether floor plan interest qualifies. There's rent for lease enforced before February 15th, which seems like you need a lease agreement, so we'll discuss that in a few minutes. And then utility payments. And what Treasury has come out, this was not in the statute that was signed into law, but Treasury has indicated that they don't anticipate allowing more than 25% of non-payroll costs being forgiven because there's going to be really high demand for this loan. Okay, the amount of the loan that's forgiven, it can be reduced if you cut employees during the 8-week period. So let's say you get the loan on April 1st, the 8-week period would be all of April, all of May. If you have cut any employees during that 8-week period, or cut salary of some of those employees during the 8-week period, it can reduce how much tentative loan forgiveness that you could receive. And then also if you received the $10,000 advance under the EIDL loan, which I don't believe many people have applied and actually received the funds to date, so that's probably not going to be applicable. And then I will hand it back off to Colin for the Q&A, and we'll go through the different areas that there have been more questions about.
Yeah, actually, I'm going to help you out with that, Denver, but why don't we start with talking a little bit about the limitation of the 500 employees. What if you have several companies and all of them are under, how do you get, if you have over 500 employees, can you talk a little bit about the aggregation rules with the IRS and how that works?
Sure. So the aggregation rules don't exactly follow the IRS. It's based on the SBA statute. So how this is going to work is, as I mentioned before, and this question has come up a lot because there's a lot of groups that have multiple dealerships or multiple other entities. So if you read right here, to be eligible, you have to have 500 or fewer employees. So when you define employees, it means full-time, part-time, or any other basis, which would be if you're leasing employees, for example, and employees of their affiliates. So what the SBA affiliates rules essentially state is any business entities that are commonly owned or commonly controlled would be treated as one group. There is a carve out where you wouldn't have to add affiliated employees when you're doing the calculation, because remember, you're applying for the loan on an entity by entity basis. So if, and I'll have an example in a second to show you how this works, but if the dealer operates a franchise and the franchise has been assigned a franchise identifier code, they wouldn't have to include affiliated employees when they're doing the 500 tests. It would only be for that franchise location. And just
I can go into an example if you'd like, Denver.
Yeah, I was gonna mention real quick.
Sure.
You don't actually apply for the franchise identifier code. It's the OEMs that apply for it. And I'll show you the brands. Colin can jump in and then I'll give you an example.
So if you have a group, maybe you have a 20 dealer group and you have multiple brands, and this is the list as of the 31st. And the expectation is this list is actually going to change. You can see certain very large brands are not on there. You don't see Toyota on there. You don't see Mercedes. You don't see GM. And what that means is if you're a 20 dealer group and you're GM products only, or GM, Toyota, Mercedes, just not on this list, then you're over 500 employees, then you're over 500 employees and you're not yet eligible for this PPP plan. But conversely, if you had dealerships that were all within the brands that are represented on this list, you would be exempted because all of these brands are eligible franchises, and franchises fall into the same category as restaurants when it comes to exemptions. So as long as your individual locations are less than 500 employees, you're then eligible for this program. So that's two extremes, but let's just say you're a 20 dealer group and half of your stores are on this list and the other half are not. And the half that are not on this list aggregate to less than 500 employees, then you would be able to continue moving forward with your applications, and you would have applications for each one of those entities that would have employees. So if you have multiple entities and some don't have employees and some do, you're not applying for the ones that do not have employees, because the baseline of this application is your actual payroll.
Okay, and 1 second, sorry. Okay, so real quick, to follow up on this, there are a lot of OEMs that are currently in the process for their applications to receive this code. And as you can see, the SBA was updating their franchise directory on a daily basis almost, but I believe they're getting really overwhelmed with these applications. The link at the bottom is actually the directory where you can go to. The last I checked, it was only updated through March 31st. But as far, I mean, all we know, some of the brands that are not on here could have been approved in the last day or two. But let's go through an example of how this works. So if you have a dealer with 3 stores that are commonly owned in separate legal entities, so let's say you have Kia, General Motors, and Lexus, and you have an employee count per store. So the Kia has the franchise identifier code. So when they're counting their employees, they don't have to include employees from affiliated companies. So they would not have to include the employees from GM or Lexus. They would stand on their own. Now, if Kia did have over 500 employees, they would not be eligible for the loan. But as long as they're under 500 employees, they're going to be eligible for the loan. Now, GM and Lexus, since they do not have the FIC code, they are going to have to, you're going to have to combine both those stores when determining the 500 employee test. Currently, they don't have an FIC code, so when you combine both those stores, you're over 500 employees, meaning the GM and the Lexus store would not be eligible to apply for this loan. I will say, at this time, it seems like almost all the manufacturers that are not on the list are applying. I would go ahead and go through the process of calculating what you think your average payroll costs, fill out the application, and start talking to your lenders now. And maybe you can even submit it to them in anticipation that those brands will be accepted if you are running into situations where some of the brands don't have the FIC code and it's preventing you from being eligible for the loan.
So Denver, if we have under 500 employees, do I just need to fill out one application?
Are you talking about having, let's say you had the scenario of 3 stores and when you combine all 3 stores, you have under 500 employees? Is that your question?
Correct.
As far as I know, you have to apply individually. It's based on the tax identification number. So think of it as like tax returns. Each of those stores, if they each file a separate tax return, you're going to have to file a separate application.
And can you talk a little bit about what is included in the total payroll calculation again?
Okay.
More specifically, the employee versus employer tax portions.
Okay, so we don't have definite guidance yet, but our general belief at this time is, for example, on group health benefits, it would be what the employer is out of pocket for. So for example, the employer is going to pay the total health bill and they're going to get reimbursed by the employee through reductions in the employee's paycheck when they're getting their every 2-week pay check or whatnot. We think that, or I think, and other people I've talked to, it's only what the employer is out of pocket for. You can't include the employee portion as well, as far as I know. But all I can say is the bankers are going to be approving all this. So, I mean, I guess it can't hurt to, when you do your application and you're providing documentation on how you come up with your payroll costs, you can include a row for what your the employee portion is for the group health benefits and insurance premiums, and then see if the banker is willing to approve that. But as far as I heard, and Colin can mention more, but I don't think these lenders are going to be approving these right away. I think what I've heard is they need some more guidance themselves to know what all qualifies.
And what kind of payroll support do you expect that these applicants will need to show the bank? Do you have any recommendations on that?
Let me see what the statute, as far as I know, it's going to be payroll tax returns. Sorry, 1 second. Let me pull this up. I can just read to you what the statute says. I think, though, we're going to need more guidance from the the bankers are going to need more guidance on what they have to request. And I think at this point that what they're trying to do is get the money out as fast as possible. And then on the back end, when you're applying for forgiveness, is where you're really going to have to keep track of all your records of what you pay, because if you don't have the records, then you can't get any amount forgiven on the loan.
And we had a couple of people that asked questions about the independent contractors and how that figures into there. Can you speak a little bit about that?
Sure. The independent contractor question, that's one of those gray areas that, depending on the publication that you read, there's conflicting information. There's a thought that if you have, for example, in dealerships, it's not uncommon that you have your own salespeople, and then you have certain folks that are basically like sales companies. They have their own company, and therefore they get a 1099. So the question is, would you be able to consider that 1099 commission-based payment as part of your payroll? So the answer is, we're not sure. We've heard certain instances where you would, and it does make sense that you would if it's specific to a payroll type person. They're working for you only, but they do qualify as an independent contractor and not as an employee, you should actually be W-2ing. So we're expecting to get answers to that, but we're starting to run out of time. So my opinion so far is if it's significant to you, you can consider including, or at least work through it with your lender. If it is not significant and it doesn't move the dial as far as the 2 times the monthly amount, it might not be worth pushing the envelope and attempting to get that included in your loan. One other comment that was out there, I was going to try to respond, and I apologize if this is a duplicate, but the question about group health insurance, there have been a lot of questions as well about, it specifically says health insurance. So what happens when you have vision or dental or other insurance? Well, in many cases, those are paid fully by the employees. So of course, if those are paid fully by the employees, the question's moot. But if there are payments that are made, for example, insurance premiums that are paid by the employer, should those be included? And right now, again, that's one of those areas where it's not defined, and there's not a clear-cut answer as to whether it would be eligible or not. It makes sense that it would, because it does fall into the health, into benefits, but it doesn't fall into the health benefits.
And then just to reiterate, there's no collateral needed nor any personal guarantees for this program? Question?
No, there's not.
Correct. I think there's one other item I wanted to clarify. There was a question that I know Denver has addressed this, but this $100,000. Denver, do you feel like we've covered that adequately?
Just to go back on it, my interpretation is the first 100,000. Well, okay, so there's 2 different parts to this. When you're doing the part we were trying to come up with the loan amount that you're going to receive. So you're going to be looking back in a 12-month period. My interpretation is the first 100,000 can be included per employee, but anything that's in excess of 100,000 would not be included in the payroll costs.
Agreed. I wanted to answer a question that came up. At the end of the presentation, there will be some questions that we'll need to have you answer if you'd like to get the PowerPoints emailed to you. So make sure you hold on and do the questionnaire, and you'll be able to get the PowerPoint presentation. I just wanted to get that out there before I forgot.
One more question, Denver, for you before we go into the loan forgiveness. If I accept funds for this PPP plan, do I have any limitations in participating in any of the other programs that are offered right now?
Yeah, you cannot use, if you get the PPP loan, and actually I'm gonna pull up the application right now so everyone can see it in case someone has not seen it yet. Let me see. Oh, actually, sorry, let me pull it up real quick. I'm not able to get it up, but when you do on the, when you fill out the application on the PPP loan, you have to specify what expenses you're going to be using the loan for. And if you're to go and get the economic injury disaster loan, you cannot take that loan out for the same reasons that you are getting the PPP loan for.
And then one other question, going back to the $100,000 limitation that's there. Does that include just salary, or does that include some of the other employee costs that we were talking about before that's included in compensation?
In the spreadsheet itself that's out there, the payroll costs is one line item, and then it has reconciling items, which include healthcare and other items. So we believe the 100,000 is limited, and then you add in the other components of payroll.
All right, can we go back?
There was another question about components of payroll costs. Bonuses are included in payroll costs. So when you're going back and you're doing your measurement, you would need to include your bonuses. That goes for both the measurement of the original loan amount and also the reimbursement that we'll get to at a later time.
So Denver, can you tell us a little bit about the loan forgiveness portion of it now? What expenses can be forgiven under this program?
Okay, sure. Let me go back to PowerPoint just to get it up.
And who approves these forgiveness? Is it the bank or is it the actual government?
The bank is going to review the application for the PPP plan. They will provide the funding. The SBA will guarantee it. It will be carried by the bank. And then when you get to the point of forgiveness, which is 8 weeks after you get your funds from the PPP plan, the measurement period is 8 weeks. Then you have to get all of your documentation in order, gather it up, submit it. We're expecting you would be submitting it to the SBA for scrutiny and approval. Because then the SBA would pay the bank for the amount that's forgiven, and then your loan ends up being that net amount.
Yeah, and to go into the expenses, if I go back one slide for the acceptable uses of the funds, the statute's written, it says that, payroll costs, but interest on mortgage obligations, rent, including rent under a lease agreement, utilities, and interest on any other debt obligations that were incurred before February 15th, 2020. What you're using the funds for are not completely the same as what qualifies for expenses that count towards the forgiveness. Because it's a little bit of semantics here, but the qualified uses of the funds, you can use it for rent expense, but when you go to get forgiveness, that rent expense to qualify as a forgivable amount, that rent has to be on a lease that was in force before February 15th, 2020. So if you don't have a lease agreement, you could potentially have a problem there when you go to the banker, and they might ask you for the lease agreement, and then if you don't have the lease agreement, then that could be an issue. And I know the question has come up a lot about is floor plan interest expense will it be covered where you can essentially be reimbursed for that? We don't know the answer yet, and we're waiting for more guidance. When it defines what a mortgage is, it says indebtedness on real or personal property. But I think the term mortgage, we're not completely sure if the floor plan interest expense is going to fall within that definition. And NADA is trying to obtain guidance on that.
I think as well, there can be other types of loans. Maybe you've got a line of credit, or maybe you have a working capital loan, or you have an asset-backed loan if you're in a buy here, pay here world. Those are in the same category as floor plan. It does make sense that they would be, but the clarity on what all is included is not yet out there. We're expecting that to come out between now and when they actually start going through the forgiveness process. They're having a hard enough time getting this up and running. There's concern that they might not even be able to start processing loans tomorrow, as they've all said. You want to go over that? I think we talked a little bit about utilities. Or do you want to go through the
Yeah,
example?
we have a question out of what type of utilities count towards this loan forgiveness?
Yeah, what it says explicitly in the details, it lists out electricity, gas, telephone, internet, water, and transportation. Which actually seems a little bit broader than I was expecting. Now, we mentioned earlier that there's a high likelihood, because the SBA actually came out and said it, that they're going to cap the reimbursement of non-payroll at 25%. So there's a good chance that a lot of these little nuance type items might not even make a dent in that in the reimbursement piece. It might be mostly payroll. There you go, Denver. Thank you.
There's the answer to the question about the utilities. This is what's written in the bill, and that's all that everyone has right now.
Okay, so we have a question of what if after you receive this funds, you're forced to have a mass layoff or a furlough? Are there any ways to remedy this reduction that could not, so you're not adversely affected in your loan forgiveness calculation?
Okay, I think we're gonna have to walk through some examples of how this works so everyone can get familiar with it. This is probably gonna take about 5 minutes, but it's complicated to answer. Okay. Okay, so as I mentioned earlier, these are the reasons that can reduce how much the loan amount can be forgiven. And I'm going to go back one slide and start this example off, and then we can follow through, and hopefully this will help give a better understanding of how this works. So you have dealership A that has 1.2 million in wages, commissions, and salaries in the prior 12 months. That would mean their average monthly payroll cost would be 100,000. So dealership A is eligible for a Paycheck Protection Program loan equal to the lesser of 250,000 or 10 million. The 250,000 is derived by multiplying the 100,000 by 2.5. Okay, so you just got this $250,000 loan, and let's assume it's on April 1st. Well, during the next 8 weeks, which would be 2 months, the dealership borrowed the 250,000. It's going to incur payroll costs, rent, mortgage, interest, utilities, and let's say it comes up to 210,000. The 210,000 would be the amount that's eligible for forgiveness, and the remaining 40,000 is not going to be eligible for forgiveness, and it would be a 2-year loan, and the first 6 months are deferred. So now the question is, on the previous page, we talked about $210,000 being the amount that's eligible for forgiveness. So now we need to see, will that $210,000 be reduced? So the items that can reduce it, and I'm only going to cover the first two, is if you cut any employees during that 8-week period. So remember, we're talking about the 8-week period. If you get the loan on April 1st, then it's going to be those next 2 months. If you lay anyone off, fire, or furlough people, it can affect your how much you have forgiven. Or if you cut the salary of some employees during the 8-week period. And you'll see why it says some employees, because highly compensated employees, which make over 100,000, won't fall into the calculation. Okay, so reduction of employees. So, and this is complicated, but just try and stay with me, and I'll have an example. The average number of full-time employees per month employed during the 8 weeks following the loan date. So that would be that 8-week period. You get the loan on April 1st. Now you have 8 weeks, and it's your average number of full-time employees over that 8 weeks. You're going to take that amount, you're going to divide it by, and you have the election to choose either or, and you're going to want to pick the one that's more beneficial to you, obviously. Your average number of full-time employees employed by from February 15th, 2019 to June 30th, 2019, or your average full-time employees from January 1st, 2020 to February 29th, 2020. And the definition right there, full-time employees are determined by calculating the average number of full-time equivalents for each pay period falling within the month. And the question might be, what is a full-time employee? I would assume it would be 40 hours, but I don't know for sure yet. Okay,
I
so
think there's definitely differing rules. I think for certain purposes, 32 hours is considered a full-time employee. That's mainly the HR definition.
Okay, my apologies then. The dealership, so let's assume the dealership had 10 full-time employees during the 8-week period, which is April 1st. So you're all of April and all of May. And it borrowed the $250,000, which we talked about. So during the period of, so on that either or, so February 15th to June 30th of 2019 is the first period you tested against, or January 1st, 2020 versus February 29th, 2020. So for the first period, it's 20 employees, and for the second period, it's 16. So obviously you want to pick the one that's more beneficial to you. So you would do the January 1st through February 29th, 2020. So the dealership elects to use that period. The loan forgiveness of $210,000, which remember that's the eligible expenses we talked about earlier, must be reduced by 37.5%. That comes from taking the change from going from 16 to 10 full-time employees. So you lost 6 employees. You're dividing 6 by 16. That's where you get the percentage. So now your loan forgiveness that was $210,000 is now, the amount that would qualify is now been reduced by $78,000. So you're not going to get the 210 forgiven. You're going to get the 210 less the 78,000. To make matters even more complicated, it's not just reducing your headcount. It's also if you reduce your employees' pay. So if the amount of any employee reduction in pay exceeded 25%, so you're looking at that 8-week period. If you reduced any employee by more than 25%, their pay in comparison to the first quarter of 2020, you would have, that would affect how much you can have forgiven. And I have an example that will explain this a little, or hopefully it'll be easier to understand. But this does not apply to any employees that had an annual rate of salary or wages greater than $100,000 for any single pay period during 2019. So let's look at the example. Okay, so X, an employee of the dealership, earned an annual salary of $40,000 as of the first quarter of 2020. After dealership A takes out the Paycheck Protection Program loan, which would be on April 1st, X is, we're assuming they got the loan on April 1st and the 8-week period starts on April 1st. So it's the 8-week period is for April and May. So X's salary is reduced to $20,000. So he had a 50% pay cut because in the first quarter of 2020, he was at $40,000. Well, during that 8-week period from when he got the loan, you reduce his salary down to $20,000. So you reduce his pay by 50%. This is greater than a 25% decrease. Thus, the forgiveness amount of $210 is going to be reduced by another 20,000. That's the reduction in the employee's wages. So to cap this all back, we got a loan for 250,000. We had covered payments eligible for forgiveness of 210,000. Due to reducing our headcount, we have to reduce the amount eligible for forgiveness by $78,750. Then, because we reduced our employees' pay, we have to reduce by the 20,000 as well. So the loan amount that can be forgiven is the $111,250. The remaining $138,750 will be owed, and it's going to be a 2-year loan. The first 6 months are deferred. And then, to make this even more complicated, but this is a good thing, there's an exception. Companies have until June 30th to restore any full-time employees that were laid off, and this doesn't have to be the same employees. So remember the example I gave you. They had 16 employees and they went down to 10 during the pay period. If they hire 6 more bodies before June 30th, they won't have the $78,000 reduction. That won't apply. And then the salary level, if it's restored back to the 40,000 by June 30th, their weekly pay or whatnot, then they won't be affected by the reduction in pay either. That was a lot.
Denver, can you talk a little bit about part-time employees, how they figure into this? Or do they?
I believe it's only full-time employee. Ryan, do you know the answer on that one? I can check real quick.
I don't know the immediate answer to that, but I would think it probably is, as Colin remarked earlier, there's probably employees considered to be full-time employees. As far as the loan forgiveness, now as far as payroll costs, I believe we can count full-time and part-time employees, but as far as the items related to forgiveness, it's most likely employees that are on 32 hours or more that were considered for the forgiveness. But we can look into that further.
Okay, then, so one other question that, not to jump around too much, Denver, but going back to some rent and mortgages, we had a couple questions on related party rent, also prepayment of any rent, or what if your mortgage or rent is being deferred? Can that count towards the forgiveness?
Okay, so there's nothing in the statute that says you cannot count related party rent. I was on a NADA presentation. What they had mentioned, and I think it's a good point, if the rent is not at fair arm's length, that could potentially cause a problem. But because the lease agreement has to be in effect before February 15th, I think it'd be hard for anyone to take advantage of that by increasing their rent. But in terms of, I'm sorry, what was the other question about that?
Sorry, it was, if your rent is being deferred, how does that calculate in? Or are you able to prepay some rent?
Okay, I will say for sure, or not for sure, but I am almost positive you cannot make any prepayments, especially when they're talking about in the statute, it discusses what the mortgage interest that qualifies, and it says you cannot be prepaying. No prepayments are allowed. And then
many lenders are already deferring those payments anyway. So if they've deferred the payments, you're not required to make the payments within that 8-week period. There's no payment, and therefore there's no interest to be reimbursed for.
Yeah, one of the difficulties, though, is some people are considering whether they want to defer the interest if they can count it towards um, the reimbursement or the forgiveness, because maybe their
Exactly,
wages are
right.
down a little bit. So they might not want to defer if they want to pay that interest and essentially get it subsidized by the government by getting the loan forgiven by that portion.
Have we addressed month-to-month yet? Month-to-month leases?
Um,
I don't believe we've addressed that. I just wanted to
I
make sure.
all I can say is the statute says the lease agreement must be in force before February 15th. I guess that would be something to discuss with the banker as well. They might be able to give more guidance on that.
Well, and
And
we might get some answers after. I mean, that there are month-to-month leases that actually have an agreement in place. The question is, if you don't have an agreement in place and you're just paying month to month because that's a related party, that's probably not going to work. But if you have an agreement in place that was in place before February 15, 2020, and it states it's month to month, that is an agreement. So I would think it probably will work. But again, this is the reimbursement piece, and we're expecting significant guidance on reimbursement at a later time.
yeah, one default, Patrick, on your last point, I believe the expenses actually have to be paid, incurred and paid in the 8-week period, but we're going to need clarification on that. It's not completely clear.
Yeah, there's also a question out there about if you've currently deferred some rent payments, if you could pay in that period, like hold off on rent to pay into that period. I think that's another thing that we don't know right now that we'll probably have to look into to get back with Mary on that one. One of the other questions that came up a little bit is, you know, we talk about the decrease of employee salaries or compensation during that eight-week period. Is there anything in the literature about increasing those as long as you keep it under the $100,000, or maybe a bonus that allows them to capture more salaries into the forgiveness portion of the loan?
Yeah, so like one example I could see is you've got all these commissioned employees where historically they would be making significantly more than their draw. And so if you have a case where your draw is substantially more than the commissions because they just can't sell anything, then yeah, they're in general, they're going to be making significantly less. Now, if you want to make them whole by paying them more than what their draw is, I would think that that's certainly something you can do. And yes, that would help you with the reimbursement because you would not have a significant reduction in wages, and therefore you would have more wages to go in the reimbursement component. One other general comment that we keep getting asked, there's some inconsistency in message that's out there about what the measurement period is. A lot of the information that's out there talks about September 30th as being the measurement period. I believe in general, that's the end of that program. I think the way that it's going to work from a measurement period perspective is what I hear most commonly is the date that you receive the funds on this program is the start of that measurement period. So if you receive funds next Friday, take 8 weeks from that Friday. So then the other question was, how do you define the payroll during that measurement period? I would say in many cases, that measurement period, it would be similar to like a month-end accrual. So if you have a payroll that spans from the start of the measurement period to the end of the measurement period, then what would happen is that you would prorate it during that period.
Okay. Some of the other questions that have come in a little bit. Have we talked about the commission employees? I know you touched a little bit about that, Colin, just a minute ago, but if we have people on a commission pay plan, obviously those are going to go down with the decrease in sales that are going on right now. how does that negatively affect this calculation? Do we have any recommendations at this point, or is it unclear?
I don't think we have the answer for that yet, but I will mention something interesting. Are you able to see the screen where I have the bill up?
Not currently.
What's
No,
interesting
it's just us, I think.
when it talks about the payroll costs that qualify, it mentions salary, wages, and commissions. But when you go to the bill where it talks about reduction relating to salary and wages, when you're reducing the amount forgiven, it says the amount of the loan forgiveness under this section shall be reduced by the amount of any reduction in total salary or wages of any employee. It does not list commissions in there, so I'm not sure if, because I know a lot of people are paid on commissions, and obviously their commissions are going to be down because there's not as many people coming in the door to buy cars. So I don't know if that's going to affect the or factor into the reduction relating to the salary and wages.
A couple of other questions that have popped up before we get into the EIDL, which is what we're going to finish with here. So some lenders are deferring interest payments or loan payments and allowing you to pay them at a later time. What should you do on that? I would say if you have cash flow to be able to pay it, go ahead and pay it, because then it goes into your qualified reimbursable expenses. So that's really something you have to decide. Do you have that capacity to be able to make those payments? All right, are we ready to go over some of the EIDL loan items?
Yeah, sure. Why don't you start with why would someone apply for an EIDL loan?
You know, traditionally, dealers, again, we're focusing on dealerships, but this is applicable for all kinds of businesses. EIDL loans or SBA loans in general historically are higher fee, in some cases higher cost loans. And so they're not always the most attractive. They tend to be more of a business that needs a loan that maybe isn't quite to the point of being able to traditionally qualify. This is kind of a different animal. They look like similar SBA loans, except for the fees are being paid by the SBA. You don't have any fees that are being paid by the applicant. And so they're definitely more attractive. Now, there are some negatives that go along with it. You know, if you have an existing line of credit that has capacity and you could actually borrow on it, let's just say you've got a $10 million line and you have eligible capacity of 9 million, you've only borrowed 8 million. That means you've got $1 million capacity. Your EIDL loan, you could apply for up to 2 million, but the max that you could then get would be 1, because you already have $1 million outstanding or available to be able to take a loan against. So, in some cases, you're in a position where you could get a line of credit or a loan from another party, and you don't necessarily need to get an EIDL. Then you might not necessarily want to get an EIDL. It is more favorable right now than it's been, and of course, one of the big benefits of at least applying for the EIDL is when you apply, within 3 days of application, you're supposed to get a $10,000 grant. And that grant you're able to keep. If you then end up getting reimbursement, which I think Denver already mentioned this, but if you then get reimbursement under the PPP plan, that $10,000 loan or a grant is a reduction to the reimbursement. But if you're not eligible to apply for the PPP plan and you apply for EIDL, at the least you get the $10,000, whether you qualify or you might qualify, but you just choose not to take the funds. So EIDL, the other thing is if you're working through the PPP plan and you have a defined period where you're getting payroll reimbursed and rent and other items, when you go through the EIDL application with the SBA, you have to define what you're going to use it for. And part of that is you can't use it for the same expenses for the same period as the PPP plan. So, but it doesn't mean you can't define that you're going to use it for payroll after that 8-week period or rent rent after that 8-week period, or whatever other uses they consider to be valid uses of those funds. Other questions that I've heard, we've talked a lot about forgiveness in the PPP plan. The EIDL plan does not have any forgiveness component with it. That's something, it's a loan. It can be a loan of up to 30 years, but what we're hearing is it's going to be more likely significantly shorter periods. That's defined by the application and the results of the application. That's not a general answer. Similar with PPP, they set up to 10 years and they set up to 4%. It's sounding like it's going to be a 0.5% and maybe up to 2 years. So we don't have answers on that. I don't know if anybody necessarily does, but you're going to get your answers when you apply and you hear your answers there. I think I jumped forward and answered multiple of those questions.
Are there any limitations on what you could use the proceeds for?
Yeah, there certainly are. There's a list of provisions that you can use it for. You can't use it for distributions to owners. You can't use it for growth. You can't use it for quite a few I'm trying to keep my business, in operation types of use. And there's a very extensive application for the EIDL loan. It's more of a traditional application, and that includes tax returns and financial statements and just all kinds of information as to why do you need it? What is your economic hardship that requires you to need this loan? Because if you don't have an economic hardship, then you can work through that original table that Denver brought up. There's a traditional SBA loan, which is where you don't have an economic hardship and you still need help. That's still available to you.
Okay, I think if Colin and Ryan in Denver, if you're okay, I'd like to maybe go through some of the open questions that we have and kind of spitball through those and see, maybe we don't have an answer right now, maybe that's the answer, but maybe we could go through and kind of put some of these to rest. Some of these that I know are a little bit more specific.
And we've already answered. Sorry,
Sorry. Some of those that are a little bit more specific, we probably are going to research a little bit more. We have the name of who put in the question, so we could always get back to you on those.
What I was going to state is I think we've already addressed a few of the questions that are in there. So maybe you can start with going through certain ones that were not addressed in the discussion topics themselves. And then we'll be able to jump over to some of the open questions.
Yeah. Sorry, Raymond asked on the application, the question is number of jobs. Is this the average per month full-time employee calculation on the 2019 payroll? Do we know that on the application? I assume that would be the calculation of your average employee number.
I'd have to pull up the application myself and look, unless Denver knows the answer there.
Did you catch that last one, Denver?
It's the instructions on the application say generally it's let me see. For purpose of calculating average monthly payroll, most applicants will use the average monthly payroll for 2019, excluding costs over 100,000 on an annualized basis for each employee.
I think it needs, does it need number of employee on there too? Is that what that is looking for when it says number of jobs?
That is believed so, but we need more clarification.
Okay. One of the other questions was on, I believe the backup, but can we have the payroll taxes and benefits in lump sum dollars, or do you have to have it detailed out by employee? I think that kind of comes more into the more information you have, the better when we get to the forgiveness part. Is that correct?
That is my thought. I see some applications looking for payroll tax returns, and I think what these lenders are looking for are independent verification, really payroll tax returns that have been filed with the IRS I've seen them requesting both, but if you pull the payroll register, that's not independent verification. They want to verify the last 2019 quarterly payroll tax reports, be able to just verify that those are the employees that you paid, and there may not be some mischievous work behind the scenes to try to obtain an additional loan at 2.5 times the cost of payroll.
One of the other questions, I think it's kind of a general question, is would you advise that they place this loan money in a separate bank account and use that account for the allowed expenses in order to maintain some separation of the monies and proof of the expense?
I think that would be a really good best practice. I certainly don't think it's required, but if you want to really track to see what your uses were of these funds, I think that would be fantastic.
There's been a number of questions about the difference between the calculation period where they give you 2.5 months in the loan, but then you have to pay out the forgivable portion over that 8-week period. Can you talk a little bit about that?
I don't think they're intended to mirror each other. So you're correct. You're going to have a difference there. In theory, you can apply and get a larger loan than what's going to be forgiven. I think that's their intention. They added in the rent and interest and utilities and other items to allow you to try to get more of it forgiven. But they want that cap. So yes, there is a discrepancy. It's not, you're not getting 8 weeks of funds and then having to get reimbursed over 8 weeks. It's kind of a intended multi-component there. Also, one other thing, the EIDL, if you end up doing the EIDL and you get proceeds there, those ultimate funds can get rolled into your PPP loan, which actually has a lower interest rate. I'm not sure.
Do you have to provide collateral for the EIDL loan?
I think if it's over 200,000. Oh, I'm sorry. I believe so. Let me just double check.
I don't believe there's collateral on the collateral or guarantee, but it's guaranteed by the SBA. I think it's through, was it like for 8 months or so through the end of the year, and then it's no longer guaranteed by the SBA.
Let me step back real quick. I went back to the collateral is required for the economic injury disaster loan, the EIDL loan, and you will have to have a guarantee if the loan is for more than $200,000. There will be a guarantee needed.
Can a 1099 salesperson be used in the calculation of the average employee level?
I spoke about that before. This is an unknown right now, and the banker's ultimately going to make the decision once they have the guidance of if you can include independent contractors or anyone you're paying via 1099. So I would ask your lender who you're applying for what their opinion is and what they have heard. But I don't think it can hurt if you have the information easily accessible to include it as an additional line item for payroll costs when you submit that information in your application. The worst thing they can do is they can just cross it out and say that doesn't count towards the payroll costs, and they'll recalculate what your total loan amount would be.
We have another question about the definition of the wages and what's considered payroll. What about the employer payroll match for an OA, STI, or Medicare? That might be a question for you, Ryan, if you're aware of that. If not, that might be something we'll have to look up a little bit more.
the employer have costs? So if it's a match and it's a match for employees, well, a match, in fact, essentially there's going to be half an employer, half the employees. So the employer portion would be included. But if you're talking about Mary's question, I think that's a little bit more detailed that we may have to get into.
All right, I think that gets us about, I think, all of those open questions. The ones that are left, I think, are a little bit more specific and will probably be replied to personally, unless you guys have anything to say about that.
Yeah, I'd say that there's still a couple of questions in there that talk about independent contractors, and I think we've explained that there isn't much in the way of answers out there yet. We're expecting significant clarity sometime soon. We would expect you would have already gotten it. So one of the comments that I had to a earlier question in the answered bucket is I've heard a best practice would be if you really are looking at including independent contractors, whether it's a parts wholesale driver or commissioned salespeople who have their own company in 1099 or other ones like that. I wouldn't go as broad as like every 1099 you offer. I don't think that's something you should really be trying to stretch that far. But I think it depends on the lender and how you work through it. I think the best practice would be if you really want to do that and include independent contractors and it makes a significant impact on your loan amount, maybe you do 2 different loans. Now, I'm not saying you do 2 different loans and apply separately. Do 2 different loans so you have both of them ready to go. Go to your lender, work with them, talk to them about what they're going to accept, because they have to go through and do some level of underwriting to be able to get your loan in. And if you have your loan together and it includes items that are gray, like independent contractors, you don't want to get put to the back of the line because you have to go back and recreate your whole application. Have your other one ready so that when you're ready to apply, you can work directly with them. You have the other one ready if they say that they're going to disallow. I think that's the best practice you can have. But open that dialogue with the lender and just understand they are overwhelmed right now. They have so many applications to work through. We're lucky when we get them on the phone. Are there any answered questions in here? Maybe we should go through and share with the group. I think there were a couple that I answered. Again, you're going to be able to get the slide presentation if you answer the survey at the end. Rent paid to related parties is forgivable. We talked about independent contractors. Talked about the 8-week period. The franchise code. So if you're a franchise that is not on that list, should you reach out and try to get the franchise code? We've heard you should have it because the lender might ask for it, but that's been more speculative than anything. But I don't think it would hurt because it just depends on the lender. Independent contractors, systems. It does not appear that systems and software are considered utilities based upon what Denver brought up. And I think we talked a little bit about the end date. It does not appear it's specified 6/15, 6/30, but the examples have been 6/30. And then as far as payroll ending, we've talked about doing your kind of accrual calculation to calculate how much of that payroll fell into that 8-week period. I don't think it's defined by actual paychecks that went out during that period. So I think that answers the majority of it. And I think unless there's any other questions from everybody, we really appreciate you all joining us. Our firm's going to have several other webinars coming up. The next one's going to be tomorrow, the same time. It's going to be on SBA loans. Again, it's not going to be dealership specific. It's going to be a little bit more broad. It will be more presentational as opposed to Q&A in nature. You'll be able to see Denver and Ryan's stunning faces on here again. and get to enjoy the exciting dialogue. We're also going to be putting together a more of a tax update presentation that will be mid next week. I believe it's going to be on Wednesday. So look for that email to come out too. That will be more specifically, it will not be on SBA, it will be more specific to all the other tax provisions, the NOL changes, the interest limitation changes, other individual changes that affect everybody. So look for that email. We'd love to have you register. We're going to have a little bit more capacity so we can invite others from this kind of a smaller invitation, and that can be disseminated out. So we appreciate you all joining us, and thank you very much. There's going to be email. Everybody's going to be getting an email with the meeting link, and we should be good to go. So thank you very much, and hope to see you all again soon. Let us know if you have any questions. Our information should be out there and available, and we'd be happy to be a resource to you as you're working your way through these SBA loans. Thank you.
Thank you, guys.
Thanks.
Thank you for joining us. As more guidance comes down from our government and the IRS, we pass that information along to you on our COVID-19 financial updates page. Link is in the description below, along with other important links, including our social media. If you want to see more of the past Lane Gorman Trubick COVID-19 financial webinar series, subscribe and hit the bell icon for notifications.